The Dangote Refinery IPO may be the most important investment opportunity in Nigeria right now. But here's the problem. Most investors are about to approach it the wrong way. And that's because the data shows something uncomfortable. IPOs like this, the biggest, the most hyped, the most talked about, are usually where retail investors lose the most money. But there's a twist. This IPO shares one trait with companies like Google, Visa, and Mastercard. And that single trait has historically created once-in-a-lifetime wealth. So in this video, I'm going to be showing you two ways to approach this mega IPO. And you should consider choosing one of the options based on your personality and your bank balance, not according to the buy you are hearing everywhere. And by the end of this video, the question will be, which one of these categories do you fit into? Hello, I'm Coco Ombu. You are welcome to the Data Investors Playbook. As a Google certified data analyst, I do not invest on vibes or national pride. I track the data. I look at the depth, the valuation gaps, and historical patterns before I put a single naira into any investment, so there is no misinvestment. And that is what I'm going to be sharing with you on this channel. Seasoned investors look at the market like a game of chess. They know what to do at every point in an asset's life cycle. And IPOs are not any different, because a great story can still be a terrible investment. And to understand the future, we have to look at the past. 2019 was the year of the mega IPOs. Uber, Lyft. They were the Dangote refineries of the tech world. Massive, disruptive, and everywhere in the news. Retail investors rushed in on day one because they loved the brands, but they ignored the math, and then something happened. Because those companies were prized for perfection, there was no room for growth left for the public. If you bought Uber at IPO, it would have taken you 4 years to see some good profits. Let me show you something people usually don't look at. You are looking at companies like Uber, Rivian, Coinbase, Facebook, and you're going, these are big companies. How did investors lose money? Well, the answer is simple and dangerous. They paid for the future before it arrived. What does this mean? They paid for overvalued companies. And when reality didn't match the story, the price corrected. The bottom line is the earnings of these companies did not match the pre-IPO hype. So take a look at the table again. These are real overhyped IPOs, real entry prices, and real pain. Some of these companies never recovered. Just imagine holding for years just to get back to zero. Remember this, a great company is a terrible investment if you pay an overinflated price. This pattern repeats across overhyped IPOs, which are largely debt-ridden and unprofitable businesses before launch. But popular, and most often than not, household names. Dangote Refinery ticks some of these boxes, only that it has a very clear path to profitability. Now, if you're asking, what is the reason for this? Why do they behave like this? This is because IPOs serve a host of purposes, including being a debt relief measure for some businesses. In the Dangote case, about $5 billion debt. It also serves as a get our money back strategy for early investors and founders, not necessarily to make new investors rich. Now, here's the uncomfortable question. Is the Dangote Refinery already priced to perfection with a $40 to $50 billion valuation? Because if it is, then your entry point matters more than the company itself. And this is where you need to be honest with yourself so that you understand what kind of investor you are, so that you can be able to balance your risk to reward. And not because the company is bad. In fact, from all of the macroeconomics, you can see that it's actually a great company, but so that your expectations will match reality. Keep that in mind, because in a few minutes, you have to choose. Now, everything I've shown you points in one direction: avoid the hype. But if it was that simple, nobody will be making money from IPOs. Because there's a second story the data tells, and this is where things get interesting. There are few overhyped IPOs, very few, that completely break this pattern. I'm talking about companies where if you hesitated, you lost the opportunity forever. If you bought Google, Visa, Mastercard at IPO, you didn't just invest, you positioned yourself inside global financial infrastructure. These were not just good investments, they were category-defining wealth creators. So the question becomes, what did they have that other overhyped IPOs didn't? The answer is simple, but most people get to miss it. These were monopolies or something close to it, like in the case of Visa and Mastercard. They are duopolies. They are not just big companies, they offer indispensable infrastructure. Google became the internet's gateway, and Visa and Mastercard became the rails for global payments. You don't compete with these companies easily. You depend on them. It's a control of the system. If you bought a company like Google at IPO, you encountered a once-in-a-lifetime opportunity. At opening bell, it went off at $85. Retail investors bought at $100. It only dipped by 4% to about $96. And from that point, the Google stock has never looked back. Visa and Mastercard has not an exact, but a close, semblance to what happened to Google. In the world of overhyped IPOs, these are outliers. Now, if the Dangote Refinery has that same trait, then waiting can cost you more than entering too early. Because this is not just a refinery, it is potentially the backbone of fuel supply in the most populous country in Africa. And that creates something powerful, a captive market. This is not just an investment, it is tied to how fuel flows across an entire nation. But don't get carried away, because this is exactly where investors make their biggest mistake. They see the story and then they ignore the maths. And the math here is aggressive because markets don't reward hope, they reward performance. Now let's look at the numbers. The refinery cost about $20 billion to build. We're talking about the land, the steel, the pipes. But the IPO is targeting as much as $50 billion. The Dangote Group has a massive $40 billion expansion plan for 2030. They need money for this expansion and to pay back debt used in building the refinery. If you buy on day one, you are likely going to pay $30 billion premium on the original costs. So understand what that means. You are not buying what it is today, you are paying upfront for what the refinery can become. For that price to be fair, the refinery just doesn't need to work. It needed to have been generating record-breaking profits from the beginning. If anything goes wrong, such as dip in oil prices, maintenance delays, other forms of risk, this valuation could pop like a bubble. Then there is the input risk. This refinery imports about 65% of crude and gets about 35% locally. A refinery is a machine that turns crude into profit. But what happens when the input becomes expensive because of transatlantic shipping? It shrinks profit margins. Stay with me, let's bring this home. The closest thing we've ever seen to this kind of national champion monopoly IPO is oil producer Saudi Aramco. It was overhyped and it faced similar skepticism, just like the Dangote IPO, about its valuation. Yet, it remained a cornerstone asset because of its sheer scale. On day one, Aramco listed on the Saudi Tadawul Exchange on December 11, 2019 at 32 riyals. And instantly, it hit the 10% daily limit, closing at 35.2 riyals. The drop was driven by institutional and retail necessity. Every local fund had to own it, and retail investors were incentivized with bonus shares if they held for 6 months. By day 2, it continued with its climb and hit a $2 trillion valuation. It hit a high of about 38 reals in its first week. But by January, February, the hype had cooled down and it began to trade around 34 reals. While the stock didn't crash, it dipped back into 32 reals, its original IPO price. We bring this back to the Dangote Refinery IPO. Like Dangote, Aramco was a captive market. It had enough scarcity value to give an investor pure play in this particular segment within that particular region. The national pride factor was also involved, and there were offers of dividends, just like the Dangote Refinery is offering dividends in US dollars. But then, comparing these two IPOs, Aramco was 86 years at IPO, while Dangote Refinery is 2 years. It was the world's most profitable company in 2018 with 111 billion US dollars. Dangote Refinery profitability is still awaited. Aramco had 100% internal crude supply. Dangote Refinery does not have full local crude accessibility. With all the Aramco strength, price still cooled and served as entry points for later investors. Because hype always has an expiry date. And this brings us back to you, because everything from this point depends on one decision. Do you chase the opportunity at the get-go? Or do you wait for the earnings report data? Or wait to enter at a discount because it may come? There's no neutral position here. So here's where we decide on the options we have, and each one comes with its own costs. Option 1, buy on day 1. If you buy Dangote Refinery IPO on day 1, you are the momentum investor. And you are betting that being early is more important than being precise. And you have agreed that the first mover advantage in a monopoly is worth the premium you are going to pay for it. And you want to participate in the dollar dividend structure from the get-go. But your risks are you may act as exit liquidity to institutional backers of the Dangote Refinery. This means that you will pay volatility tax, but you don't mind because you believe in the business. Then, oversubscription may see you not getting as much of the shares as you want, and you may have some of your money returned back to you. Option 2, if you wait, you are the fundamental investor. You are banking on the data that the hype always cools, and that the lockup expiry, which is usually 1 year, when founders and investors will be selling to try to recoup some of their investments, you will get a better entry price. Basically, you are betting that the market will give you a second chance. But you are at risk of the Google effect, because there is a chance that the price may never return to the original IPO level. So, make the above considerations with the data provided and choose how you want to roll the dice on the Dangote Refinery IPO play. But here's the truth, both strategies can actually work. The difference is if you understand the game that you are playing. So tell me in the comments, are you going in on day one, or are you waiting for the data on the earnings report, price dips, lockup expiry periods, before owning a portion of Nigeria's crown jewel infrastructure monopoly IPO? So in the comments, type who you are, momentum or fundamental. Remember, all investments are risky. This is investment analysis, not investment advice. Through the Data Investors Playbook, I bring you a rollout of data and insights on any investment so that you do not go in blind. If you like raw hard data on assets and investment so that you do not misinvest, please subscribe, like and share this video with a friend. For deeper analysis and pure play visualizations, join the Data Investors Playbook on Substack. Until our next video, let the data guide you. See you soon.